Welcome to Remarkable Retail Podcast, Season 8, Episode 3, presented by Salonis. I'm Michael LeBlanc.
And I'm Steve Dennis.
Well, you asked for it, listeners, and you've got it. Steve's annual prediction episode is finally here, and our first solo episode for Season 8.
Oh, yes, the much anticipated predictions. So we'll see if I have learned anything from my past efforts of making predictions to try to make these a bit more tangible and measurable. I think I may want to suggest that when we do the review at the end of the year, we do it on a pass-fail basis rather than try to grade it, because we do past listeners or longtime listeners will know that sometimes it gets a little bit hard to really grade these things based upon the data available. But anyway, give it a try.
All right. Well, very exciting. Now, reminder to the listeners, we'll be back at Shop Talk in Las Vegas coming up this March. Steve, you'll be on the stage. And you could be there too, listeners. Check out the show notes to get yourself a nice discount. And speaking of March, excitement is building. Your new book arrived on the shelves. But I think in advance of that, you have an offer for the people, yeah?
Yeah, we mentioned this a couple weeks back that there are some pre-order offers. So you get some free stuff and access to some things by pre-ordering the book and sending me the receipt. Because we got the receipts. And if we get the receipts, you get something special as well. So we'll put the details in the show notes, and hopefully that's self-evident. Also, speaking of Shop Talk, I will be doing a Leaders Leap book signing, I believe on Monday of the show. We're still kind of working out the details, but we'll share those when they are available.
Fantastic. And I got my advanced copy as well. It is now well thumbed, so as the readers would say. So listen, everybody, it's a great book, and I think you want to run, not walk. Take advantage of that offer. All right, there's the promo piece for us. Let's get to the news of the week before we get to our solo episode. So let's start in China. This whole China direct model, I think you talk about a little bit in the predictions. Some news from the two big players, Temu and Shein. Let's start with Temu first. They seem to be spending some money online in a pretty significant way. What do you think of what they're up to?
Well, as I'm sure at this point most people know, both these brands have been growing like crazy. I think Temu is the fastest growing retail company of all time at this point. I also saw, maybe we'll put this in the show notes as well, that there was some data on their age cohorts. And there's a surprising number of older people, at least surprising to me, that are shopping on Temu. So this idea that it's just all, Gen Z or whatever appears not to be the case. But yeah, they are just spending a ton on marketing. The particular thing this week is that Media Radar reported that their paid marketing is going to be up 1,000% year over year.
Well, were they spending a lot to begin with? Do we have a sense of that?
They've been spending pretty heavily. I think the numbers are a little bit hard to come by, so I'm not exactly sure how they came up with this calculation, but I would say that they are definitely stepping on the gas. I'm not sure how this all translates to profitability. They are owned by PDD, so they're part of a corporate entity that perhaps can withstand the cash going out the door for a while. And then the other piece of news from the Chinese fast fashion folks is that Shein, which we discussed, I don't know, a month or two ago, that they had filed confidentially for a possible IPO. There's now some sense that may not happen, or at least not happen within the next few months, as they're getting challenged on a bunch of things. So we'll see how that progresses. But yeah, it's looking like that's being kicked down the road a bit.
Let's talk about a brand I used to work for, Levi's, and eBay at the same time. Some news around layoffs to start the year. Yeah,
we are. And I know last year we talked about kind of what seemed to be a pickup in tech layoffs in particular, and wondering whether that would have some contagion effect and lead to unemployment going up. And turns out overall, and at least in the U.S., unemployment has continued to be low. But it does seem like we're seeing more news. So Levi's is reducing, I think it's about 15% of their corporate staff. I think we're going to see some pretty poor numbers coming out of anybody that's touches the department store space, both the department stores themselves, because we had Macy's layoffs we talked about last week. Levi's obviously sells into Macy's, Kohl's, a bunch of other those players. So new CEO there. So a lot of times, just like we talked about with Macy's also
Michelle
last
Gass,
week.
right?
Michelle Gass coming out of Kohl's. So this also may be, go do some hard stuff at the beginning of your tenure and then set the stage there. So that might be part of it. eBay, I think, is a broader issue of just slowness in the e-com space more broadly. So I think a lot of people anticipating that business is going to be challenging, at least in the immediate future.
Speaking of department store category, Macy's had another takeover? I'm losing track. There's lots of these news around takeovers, but they don't seem too fussed on the offer.
Yeah, no, it wasn't another offer. It was the same offer that we talked about whenever that was, a month or so ago. They formally responded saying that they didn't believe it was in the interest of the shareholders to accept the offer.
And that was five and change billion, I think.
Yeah. When we talked about it the first time, I said that I thought it was very unlikely that they would accept the offer, mainly because almost no company accepts the first offer anyway. Right. So I don't know whether this is just a negotiating tactic to get the offer up, and whether if the offer comes up substantially, the deal might happen, or whether really Macy's is digging in. I think the timing is pretty unusual because I think literally a couple days after this episode comes out, Tony Spring will be taking over as the new CEO. So to have somebody just starting and saying my first action is to sell the company seems kind of unusual. And whether it's a good reason to say no or not, I would not predict that this deal is going to happen unless the offer comes up a lot. But we'll see.
Longtime listeners would or might remember back in season 5, we talked to Neighborhood Goods CEO Matt Alexander, who from the Dallas area, someone you knew. Not so great news coming out of our friends, or coming out from our friends at Neighborhood Goods.
Yeah, so we talked about Neighborhood Goods a couple episodes back because they had closed or announced that they were closing 2 of their 4 stores, which didn't sound super optimistic. And now it turns out they are shutting down completely. So their attempts, I have a little bit of background information because of some connections here in Dallas, some investors in Neighborhood Goods, where apparently they were, I haven't talked to Matt directly, or indirectly, but people that know what's going on, that they were attempting to get some new financing, that kind of stuff, and that did not work out. So yes, they are shutting down, joining Showfields, a similar kind of model that shut down recently as well. So yeah, that great hopes there, but unfortunately not going to continue, or at least if they come back, it would be in a presumably different form.
Well, he's a talented individual. I really enjoyed our conversation. So
absolutely.
We, wish him best, and I'm sure he'll land on his feet, given what I know about him from our conversation. Speaking of store closures, we got some numbers around store closures. We talked about openings, but we saw some percentage numbers around store closures that we wanted to share with the people.
Yeah, so a couple episodes back, we talked about, obviously there continues to be good growth in physical retail, despite commentary to the contrary, because there were quite a lot of openings last year. When you look at the closures, they actually were up over 80% year over year. Now, still more store openings than store closures, but I guess I didn't realize the degree to which store closings had gone up so much in just 1 year. Now, Bed Bath & Beyond and Rite Aid are a pretty good chunk of that number.
Pharmacy guys in general are closing a lot. They're probably overbuilt, so they're probably a big factor in that number, I'd suspect.
Right. Yeah, but I think one of the things that's probably contributing to this that you and I talked about, I think multiple times on the podcast, was there was this kind of retail is back narrative post the worst years, or the 2020, 2021 COVID impact. And, we had government stimulus and a lot of things that caused overall retail spending, not just in physical stores, to be unusually high. And I think the thing you kept bringing up is that, doesn't that mask some, maybe has a poor performer look like an okay performer, but that will be short-lived. And I do think, in addition to the obvious problems that a couple companies in particular, I do think the broader store closure thing is that, as we get to a little bit more normal pattern of spending and maybe some suggestion that the next year or so is going to be difficult, it's an opportunity to right-size your fleet.
Well, speaking of store openings, Ikea has announced that they will launch 4 more plan and order point with pickup. Now, what's that? What's that all about? I guess I can back out all those words, but tell me what you think about what they're doing.
Well, I wanted to mention this. 4 stores in the scheme of things is obviously not huge, but it is a positive story of growth compared to some negative stories we had here with layoffs and shutting down. So a little bit of balance. But I think it's also part of what I think is a very interesting strategy that many companies are employing some version of, which is having these destination, and I'll talk about this in the predictions a little bit, but it's sort of like magnet stores, destination stores, which the big blue boxes at IKEA are an obvious example of that. But then trying to get closer to the customer with these more, so it's kind of like a hub and spoke system by adding these smaller locations. So these are small stores where you can pick up your products. So it makes it a lot easier to do buy online, pick up in store, and not have to hike on up to, half an hour, 45 minutes to the big IKEA store. But you can also actually meet with sales associates and do some design and planning and pick things out. So it's kind of a showroom model, I guess you could say in some respects, but much, much shrunken down from the big blue boxes we know and mostly love.
It's a little bit like the Nordstrom strategy of their small stores where you could go and do alterations and do your returns and do your pickup, because, there's only, there's 2 big Nordstroms that we were actually staying close to in New York. So I get it. I think it's a great idea. I think it epitomizes what you talk about, listen, you've got the blue box, you've got the big destination stores, but they're not always easy to get to. And anyway, watch this space, because we know IKEA and they're they're top drawer retailer. Let's talk about shipping. So, we haven't talked about that in a while as an industry, because it kind of went away, during the COVID years, it was just bananas, the container rates were like,
it was safe to go back to the supply chain.
Container rates went from like whatever they were to like 20, 30,000 companies, retailers are buying their own boats, for goodness sakes. Now we see, with the disruptions in part of the supply chain, we see that container rates are on the upswing again. So what do you think, and what are you reading about that?
Well, there's a couple things here. So last year, I don't know that we talked about this all that much, but just following retailer earnings, there was quite a lot of commentary about margin improvement related to shipping costs coming down to where they had been. So when people were explaining, our gross margins were up, blah, 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 some of that was attributable to pricing and better markdown performance, but some of it was related to transportation cost. And now I think we should brace ourselves for commentary about shipping costs going up. So the particular news story was that the average global shipping cost for a container was up 23% in the last week, which is a doubling in the past month. And then spot market rates for containers from China to LA, which is a popular route for probably obvious reasons, have increased 38%. And then my last number here is that maritime traffic through the Suez Canal has fallen by 37% so far. So I think we've got both this cost hit as well as the potential for inventory to be missed or late. I guess not missed entirely, but as people have to go to alternative routes, well, it will extend the time for product to land. So whether that'll turn out to be much.
I've heard up to 10 days. And to your point, there is some fresh product on there, like that is coming through that route that gets spoiled because it's just time to ripen on a normal boat. So I think the Europeans are more, generally speaking, more impacted by the Suez Canal issue. But I'm hearing from retailers here, because we do take, and I'm sure in the U.S. you do take some deliveries on the East Coast. That's not often the West Coast. So
correct, sure.
So Always an interesting career. If anyone's thinking about a career change or looking for an exciting career, go into supply chain. There's always something exciting to deal with.
Indeed.
All right. Well, that's a good wrap. Now, before we get to our predictions, let's hear from our presenting sponsor, Celonis. Want to ramp up speed and productivity for your entire retail operation? In the Celonis Process Mining for Dummies Handbook, we show you how Celonis process mining technology, enhanced with process intelligent AI, can help you streamline performance across your entire retail business so you can drive lasting value from end to end. That means purchasing, supply chain, omni-channel execution, merchandising, and customer service processes, all managed and optimized through one powerful software solution. To get your free copy of Process Mining for Dummies and see how it's generated millions in value for brands around the world like Aldi, Globus, and Edeka, head to celonis.com/remarkable retail. All right, listeners, you asked for it. You got it. You've been waiting for it. I've been waiting for it. 2024 retail predictions. The Baker's Dozen episode, I guess we could say. Steve, give me a sense of, before we start in, give me a sense of your tradecraft around how you come up with these.
So my process I do have one. It's essentially taking notes during, probably starting in the fall sometimes, anticipating I'm going to do predictions. And I just add to this list over time. And then as we get closer to wanting to do this episode and write a Forbes piece and that kind of stuff, I just start going through them. And I'm listening to, in some cases, to what other people are saying. So I just start to digest them and maybe combine them and say, this definitely should be on the list. Maybe this one drops off. So it's really kind of an iterative process over several months, but definitely gets more intense as January approaches. And so here we are. And I do try to, as I kind of mentioned at the top, I do try to think, well, is this actually something that can be measured? Is there an ability to actually tell whether I got it right or largely right or not? So that's usually my failing, is not thinking about that too carefully. And then we get to the end of the year, as people may have heard with our recap episode, where I go like, I don't really know whether that happened or not.
All right, well, let's jump in. Let's start with the moneymaker, bifurcation, as we heard on the Placer AI podcast or the Placer AI webinar this past week. The word bifurcation came up a few times, and you get a nickel or something every time somebody says it. So let's start there.
Yes, or an angel gets its wings or something. But yes, something happens because I own the word bifurcation. Or as some of my other friends, the Europeans seem to like to call it polarization with an S. Members of the Commonwealth have that spelling thing. So, but yes, I'm talking about bifurcation.
We refer to that, by the way, as the King's English, by the way. So
I got it. Yes. So, yes. So my prediction is the bifurcation of just about everything accelerates. So my original people who've read my book or followed stuff for a while here will know that when I talked about bifurcation, it was largely about the collapse of the middle. So we're seeing success at either end of the spectrum of, the value side doing well and more the premium side doing well. So we continue to see that. But I think there's bifurcation really in quite a lot of things of late. And I think as we go into this, or as we're in this new year, we'll see even more of it. So bifurcation in terms of performance, remarkable brands that execute well, continuing to grow at an above average rate and have good stock performance and financial returns and all those kinds of things. And those stuck in the unremarkable middle largely continuing to struggle. So I don't think we'll see too much kind of middling performance. We'll see lots of great performance and lots of not so great performance. Same thing on the store opening, store closure fronts. The folks that are opening stores are strong retailers. The ones that are store closing their way to a better future, they hope, are on the unremarkable side. But I think, we're seeing bifurcation in malls, right? The A or A plus type malls, if people are familiar with that general categorization, tending to do quite well. Pretty much every other kind of mall, either closing or being repurposed and that kind of stuff. Office space, we're going to, actually one of my predictions relates to the commercial real estate market, but as we've talked about,
many times. Yeah.
A lot of problems in the commercial real estate market more broadly, but really good offices are attracting tenants. It's the weaker properties that are really, really problematic. As we talked about in the news with Ikea, I think we're seeing bifurcation in formats, both very large stores, small stores, flagship stores versus satellites, destination stores versus neighborhood. And again, those that kind of straddle, that middle ground tending to have challenges. And then I think we've talked about this in the past, just kind of from a consumer intention. But I think if you look at the types of retailers that are doing well, it often comes down to whether they are really leaning into buying or shopping, or some people will say jobs or joys, or errands versus experiences, mass or meaning. There's this split as to why people go to stores in the first place. And, you go to Costco because it's a great convenient value equation. You go to the Louis Vuitton store for very different reasons. But again, those retailers that are not, strongly convenient, value oriented, et cetera, but also at the other end of the spectrum are not really winning on distinctive product, great service, unique experience. It's the ones in the middle that continue to struggle. So yeah, I think we'll see this bifurcation phenomena writ large across a number of different areas within retail. All
right, number 2, let's talk about growth. What's the year going to look like in terms of acceleration or spending, and what does up look like in 2024?
Well, like I said, I think if you are a really strong brand, you'll continue to grow disproportionately. But I think for the rest of the market, and so the specific prediction is for many brands, flat is the new up. In other words, they will be happy just to kind of hold serve, tiresome sport metaphor portion of the program. But anyway, I think we're going to see an overall slowdown in the purchase of goods. The U.S. market, we just had GDP numbers, which U.S. continues to outperform what just about everybody thinks, whereas the U.K. and some other markets are, flat-ish already. Mm-hmm. I think what we're going to continue to see is inflation be pronounced in services, mainly because that's labor intensive, but that's going to put the squeeze on purchase of goods generally. We're seeing a continued acceleration in credit card debt. We've got macro volatility. I think the home market is a big driver of many categories, and that's probably going to continue to be sort of frozen until interest rates start to come down markedly, which is probably not going to happen until towards the end of the year. So I think all of this is just going to create headwinds in general. So if you aren't one of the better performing hot retailers, you're going to be lucky to be able to actually break even. And, part of that is just the math of, which I think we touched on last week, is if there's essentially zero or very, very low inflation in goods, or even deflation in some categories like consumer electronics, then you've got to grow units in order to have positive comp store sales. And I think the argument, just because prices come down doesn't necessarily mean people are going to start buying a lot more of any given item. So I think it's a challenging environment. So I think a lot of companies will be happy to just stay flat.
Let's move on to number 3. And I was wondering when AI would rear its head. And here it is, number 3.
Well, so this is title of my new movie, AI. This time it's personal. An action thriller. Well, there's a lot to predict potentially about AI. One of the things I thought about was whether AI would fall into the trough. What is that, trough of disappointment or peak of inflated expectations? I don't know. I'm screwing that up. But I think what's really going to be interesting.
It's not the metaverse.
Something coming down the line that's a little bit metaverse-y. But I think I don't think we're going to see as much of the labor takeouts as some people are predicting quite yet. I think where we'll see some really interesting use cases and we'll see retailers talking about success is using AI for more personalized experience. So whether that is better targeted in marketing or chatbots or these kinds of things, which will create through leveraging deeper customer insight to be able to have more personalized treatment. So we've talked about the one-to-one future as something since Peppers and Rogers Group in the 90s. I think we're really getting to the stage where the technology and cost of implementation may actually make that reasonable. So overall, it's that we'll see the biggest impact for retailers be in more personalized offerings.
Interesting. It's that combination of cloud computing capacity, and now you've got the AI to go through it. So it's pretty exciting for anybody who is, working in the early part of the decade on Rogers and Pepper's one-to-one stuff. We knew where we wanted to go, but sometimes we just didn't have the tools to always get there, Let's talk about, we talk about it every episode, including this one, in some way, shape, or form. DTC, we did a whole session in New York at the Lead on this. What do you think is going to happen with these direct-to-consumer model type companies?
Well, so I've got two predictions that are kind of tied to the newer age of DTC companies, largely these digitally native vertical brands. I think if you look at the newer ones, so the Allbirds, the Warby Parkers, et cetera, their growth is going to continue to be challenging because of the inherent profitability of online only. So I think the push is going to continue to be towards more wholesale. So their specific prediction is that the D continues to come out of DTC, that many of these companies actually are going to lean more heavily on going indirect to consumers. Now, I think there's a big distinction between these newer DTC brands and some of the established manufacturers like the Nikes and the Carters and
that's interesting.
Luxury vendors, LVMH, Birkenstock, et cetera, that those vendors are going to continue to invest heavily in their direct-to-consumer strategy, not only their e-commerce, but their own stores. So I think that some people call this MTC or M2C, manufacturer to customer. I think those will continue to be hot growth areas, but I think the newer brands are going to continue to explore wholesale relationships or partnerships, partially because of the challenging economics of online. But also, I just don't think there's nearly the upside to opening their own stores as some of them have seen. So,
is this where you might frame we talked about earlier on the show, the Shein and the Temus? They're kind of MTC, right? They're manufacturer or factory direct. Is this where you kind of lump them into this kind of prediction?
I would, though. I think that they're kind of their own thing. I mean, I definitely think they will have hyper growth. Come back and mention something about that in a minute. But technically they would be a direct to consumer brand, and they are essentially they're kind of a marketplace, but they're also producers. So they are kind of their own. Just like Amazon is kind of its own animal relative to most of retail.
Longtime listeners would recognize this sound.
Ooh.
That's right. We're the wobbly unicorn sound. Now you've got a prediction around the herd of unicorns. What do you think?
Well, so Rex Woodbury, who's a guy that I follow on social media, talked about the culling of the unicorn herd, and so I'll give a shout out to him. So the prediction is there is a more pronounced culling of the I'll call it the once and future unicorn herd, because some of these brands that were unicorns, so $1 billion plus valuation, have fallen. Some of them had the promise of getting there. At least investors thought that they could get there. And so I guess we already have with neighborhood goods closing, one on this list. But we'll see some of these business models continue to stumble. Now, last year, my prediction was that there would be a reset. And so this is kind of a continuation of that to maybe less of a reset, but more of a reckoning. So that will mean bankruptcies, closings, recapitalizations, major retrenchments. I think we'll, for example, see Allbirds announce a bunch of store closings very soon, write-downs of valuation, and consolidation. So some of these brands have strong brand premises, and there will be bigger companies that may want to buy them for their customer base and their branding, not so much for as a standalone growth vehicle. Yeah.
Yeah, and they're people too, right? They kind of get some pretty those, the folks riding these unicorns, so to speak, if I can mix metaphors. Pretty creative group. So I think they're great to be swept up in any acquisition. All right.
Yes, I do. By the way, sorry to interrupt, but I do want to do an on the fly prediction, which is that the Remarkable Retail podcast will once again lean on mixed metaphors very heavily in this season.
We will be talking metaphors till the cows come home, basically, on this.
Exactly.
Show. We talked again. We talked earlier in the episode around store structure. The whole Ikea not just building new blue boxes. Is this something that you think will be another thing or another thing to watch in 2024?
Yeah, so this is number 6 is Honey, I Shrunk the Store Again, because I have talked about that in my book and in past things. And I think here's another place where we're seeing an acceleration of a trend. So there's actually, I think, 3 parts to to this because, as I often say, every time I have a list, there are three,
You are a
whether
trilogist.
there should be or not. So one is, I think, the continued downsizing of existing concepts or prototypical stores. So I think we are understanding generally, with the exception of, say, a Walmart, where they're using their stores more as distribution centers. But I think generally, because of the growth of e-commerce and because of kind of the showrooming thing that goes on, that people are looking to shrink their stores. Even Nordstrom, which I'll talk about also in a prediction in a minute, they've taken a couple stores where they've gone from three floors to two. So I think we'll see opportunistically kind of companies that'll be taking space out of stores that they already operate, but also as they look forward to expansion, trying to tighten up that space. But then there's the second concept, which we spoke about with Ikea, but also this is going on with Macy's and others, of more of this hub and spoke system. So adding stores that are much smaller and really kind of thought about in a fundamentally different way as a complement to the more destination kind of stores. And then I think within malls, the space devoted to retail in malls, this repurposing that's going on where the footprint is shrunk or one of the mall anchors goes away and other things are added, whether that's residential or hotels. So I think as we look at square footage, there will be store closings, certainly. But I think, as we look at the mix of stores, we'll generally see smaller stores. And a lot of this is just getting closer to the customer. What our mutual friend Robin Lewis talks about is preemptive distribution. You can move closer to the customer because you're trying to intercept them, or just the customer is not going to go to the mall, or because they can buy online or just buy in a neighborhood store.
What's number 7? A former employer, someone you worked for a while. You've been thinking about him.
Yeah, well, we've been talking about, because there's been news about the potential that Neiman Marcus and Saks might merge, or actually that Saks or Hudson Bay, the owner of Saks, would acquire Neiman Marcus. I think it's going to happen this year, and I think it's driven by a bunch of things. One is that
that's actually two predictions in one. A, that it's going to happen, and B, that it's going to happen this year.
Just generally, a lot of multi-brand retailers are struggling, whether we're talking on the high end with Saks, Neiman's and Nordstrom, or we're talking, the mid-market department stores. I think there's just so much competition, and mall-based retailing is anchor stores, or, more anchors to the performance than the old way of thinking about being an anchor store. In particular with Neiman Marcus and Saks, while the very, very high end is doing well, LVMH just reported pretty strong quarter, Hermes, a bunch of other of those brands are doing well. The accessible luxury segment, more discretionary part for not uber wealthy people, continues to struggle. Saks and HBC more broadly, they solved an immediate crisis with some refinancing, but there are also some rumors, or I guess even it's been commented on, that they're continuing to have liquidity issues and need to do some refinancing. So
the state of their stores, by the way, reflects that. I was in a store and the elevators aren't fixed, and they're like, "We close. You can't get up, so we're not going to fix the elevators and escalate." Like, I'm hearing a lot about those kind of things that seem to point to, little cash tight flow, a little tighter on the cash flow.
Yeah. So I think I guess one way of looking at this is the level of desperation may force something to happen, or their bankers or whatever will say, look, we got to get to a sustainable place. But the fundamental issue here in terms of just kind of the episodic kinds of things is the world doesn't need two nearly identical luxury department stores, that there's too much capacity in the market. And one of the ways I've explained this to people is and I've done some of this analysis, if you go around to a lot of these markets and you try to predict the potential for luxury department stores, you often come up and say, well, this market actually needs 1.2 luxury department stores, and we have 2.0. And so it's pretty much, it's very hard to paint a scenario. I'm not talking about the Neiman Marcus North Park store or the Saks Fifth Avenue store. Like, there's, some locations which are extremely profitable. But when you get to some smaller markets and there's a Neiman Marcus and Saks in the same mall, they're just sharing largely the same customer, and both of those stores end up being very mediocre performers. So I think it's not very exciting to think about merging to take capacity out of the market or just make it about cost structure. But I think the underlying economics, there's a very compelling case to put these together. And I think their ownership structure, they're going to keep pushing to try to make something happen.
Let's talk about number 8, sticking with the department store sector, one of our favorite department stores. You're thinking about Nordstrom's.
Well, so I thought about including Macy's in this as well because of what we talked about in the news, that there's a lot of interest in taking Macy's private. You could make an argument that that's an easier deal to do because of unlocking the real estate, because Macy's controls or owns so much of it. But I actually think the more interesting one is Nordstrom going private. The family, which still, even though Nordstrom is a public company, the family's got I forget the exact percentage, but it's operates a little bit more like a private company because of that. And the family has wanted to go private. I think what's going on now that makes this more likely is Nordstrom's performance has been very, very lackluster, and it may be difficult for them to do some of the things they need to do in the public markets. And just where the price of the stock is, if you assume that we will see long-term interest rates continue to come down, this is probably more towards the end of the year. But I think because of Nordstrom's perceived strong brand value, they do have this accessible luxury part in the market that makes them interesting. But they have been a big underperformer. So I think something has to happen there. And I think going private whether it'll be successful in going private, like we've talked about, it's not necessarily so easy. Just because you're private doesn't mean it's easy to fix the reasons that are causing the underperformance, but it does allow you to take more of a long-term perspective rather than have to deal with the vagaries of the public markets.
Well, it'll be 2 interesting years back to back for Nordstrom then, because 2023, of course, they pulled out from their international expansion in Canada, pulled out of the Canadian market, and we'll see if that comes to the case in 2024. Speaking of vision, hey, I don't know if that's a good segue or not, but Apple's Vision
We'll
Pro.
also be grading the quality of your segues in 2024.
I'm not sure that was a good one. Anyway, Apple's Vision Pro is coming out. It's on the one hand, they launched it with a bit of panache, and Apple's got a reputation for helping to recreate categories. What are you thinking about the product itself for 2024?
Well, we touched on this a little bit last episode, I guess it was. So I'll try not to be too repetitive. But I think that well, I guess it depends on your expectation, but whether it underwhelms or not. But I do think it's not going to be a particularly successful product more broadly, mainly because of its form and its cost. But as we talked about last week, I think it's testing the market for a more premium type product. Meta's got their Ray-Ban thing, I guess. That's a much lower price point. That's, I guess, sort of the most equivalent. Yeah. But whether or not something quite so intrusive, I guess, or what would you call it? Claustrophobic?
Obvious.
I don't know.
I don't know.
Like right. It's a very large form factor, I guess.
It ain't subtle. That's for sure. It ain't subtle.
And which is, as you've pointed out, why we haven't seen Tim Cook putting them on. But in any event, I think it's going to underwhelm as a broad-based consumer product. But the prediction, the way I worded it, is that Apple's Vision Pro is a big nothing burger, ... for now. Because I do think it can maybe create the potential for a more mainstream product a couple of years down the road.
And I guess that the listeners might be wondering, okay, that why are we even talking about a single product in a list of overall retail predictions? And when I think of Vision Pro, I think of, one of those point of arrivals, and, I'm watching something and I can just point to something and buy it. Boy, that model had great sunglasses on. And maybe that's the connection, in addition to just being sometimes these big new product launches spark interest in the retail volumes and retail in general. Yeah. And that's why you would include something like this in here.
Yeah. I mean, if it can change shopping, if it can change the culture, and almost everything Apple does is sort of inherently interesting because it's Apple. So I think it is important in terms of its potential, but less so in terms of what it will actually do in this next calendar year.
We haven't talked about sustainability or climate change. I mean, these are very, in some ways, very overwhelming issues. But we often talk about that in the context of brands, saying, "Listen, I have a sustainable brand. It's how I make the product," and that we think a lot of consumers act like they want brands that offer a lot of sustainability and thoughtfulness around their brand. But there's a lot of mixed messages on that. And that leads to number 10.
Yeah, so this is sustainability schizophrenia hits new heights. And what I mean by that is a little bit of what you were saying there, which is on the one hand, we believe that consumers are very interested in sustainable products and purpose-driven brands and all those kinds of things. We've got an episode focused on that coming up next, I believe. But at the same time, you see this enormous growth from fast fashion brands, particularly the new ones like Temu and Shein, but also Uniqlo and
Sure.
Zara, et cetera. So TikTok is kind of tiptoeing their way into the e-commerce game. I wonder, I thought about making this a separate prediction, whether Amazon, other than just, having to respond to competitive pressures from the Temus and the Sheins of the world, whether they might launch their own kind of challenger business model. But anyway, clearly hyper growth, but it really fights against this idea that consumers are very, very purpose driven. And all we just see is this growth and prices coming down and really this kind of race to the bottom. And as you mentioned, a race to the landfill. So that really doesn't sound very purpose led or sustainably focused. But at the same time, we have many existing brands really upping their commitment to sustainability, whether that is what they do in terms of supply chain, but also, recycling of products, et cetera. Plus, we also have ThredUp and Poshmark and others that are in the resale market, and they're growing. So it's really kind of, I guess you could say it's a little bit of bifurcation in this as well, right? Because you have this unsustainable hyper growth, but then you have disproportionate growth in what brands are doing on the sustainability front. So it's very interesting, very mixed messages.
Yep. Now, your next prediction actually connects back to your first prediction and a couple of others. There are some brands that are stuck in the unremarkable middle. What are you thinking about what's going to happen to them? Is there a way out for them?
I think, unfortunately, we're going to see largely more of the same, which is that the Macy's, Kohl's, JCPenney, and other of these kind of long-suffering, unremarkable retailers are going to continue to do incremental things. One of the things I say in my book, borrowing from the lore of Alcoholics Anonymous, is that half measures avail nothing. That trying to do these incremental things don't fundamentally address the relevance and differentiation issues. So unfortunately, I think we will continue to see incremental strategic offerings, more cost cutting, more store closings, but essentially it's going to be a lot of action, but doesn't really move the dial. And one thing which maybe we'll talk about, I think I keep mentioning this, is something we'll talk about in the future, and we've yet to do it, is there's just a lot of particular reasons why Macy's, Kohl's, Penny's, and many of the mall-based folks are able to stay in business despite their terrible performance. So I don't believe any of these brands will necessarily get to a crisis point this year. So I think we'll just continue to see that they keep trying to, what I say in the prediction in particular is bailing still doesn't fix the hole. That if the thing that's really causing your demise is a fundamental problem in the business, but they're not going to be able to address that. They'll just kind of keep doing these incremental things.
Number 12 really resonated with me. I was in doing store tours in New York, and I went into the new Petco Union Square, and a big part of that store on the main floor was their health services for the doggos and the kitty cats. And when I saw number 12, it really resonated with me. Yeah,
so I say health-related services. So it seems like every year, we have one big theme. And, this past year was AI. Year before was retail media networks and metaverse. I think, the metaverse is still kind of under-delivering this year. I think retail media networks are absolutely going to continue to be a high-growth area. So I'm not suggesting that that's, just kind of like a false narrative. But I think health-related services will step more into the conversation. I think that's because, as you mentioned with Petco, but other brick and mortar retailers are investing in this area. A lot of the traditional drugstores are trying to get more into services. So this is both for humans and for pets, where the offerings will be extended into new areas. We also have brands like Hims and other online players that continue to grow quite quickly. So I think we'll see continued high single digit or low kind of teen growth from some of those brands. And then we have this whole new area, which I do think is a little bit more on the hype side of the so-called GLP-1 drugs like Ozempic that are growing, and lots of new drugs are going to be coming on the market. And so we've seen Weight Watchers and others kind of get into this weight management service piece, leveraging these new drugs. Now, I think because something big would have to happen for this really to go more mass, because I think Ozempic's like $1,000 a month.
Yeah.
So obviously, just like, with Vision Pro, the pricing, even if people are very interested in it, is a barrier at the moment anyway, or at least for the foreseeable future, to it really, really taking off. But I think it's definitely coming. And so I think we'll see more either, new ventures that are really kind of GLP-1 drug centric, or just people kind of piling on to this new category of drugs, and presumably the prices and coming down, and insurance getting involved further down the road.
Interesting. I mean, the math is so compelling and interesting to me, because if you take a big global approach, so to speak, or a life cycle approach, the money you'd spend on a GLP-1 drug is nothing compared to the health costs that would occur later on from continued health problems. So
yes,
that doesn't mean that consumers always have the cash to do that. But if you took it all together, it's a pretty no-brainer versus the outcome, which could be much, much more expensive and much more harmful to.
Well, you're being very logical and very Canadian, but if you know anything about the U.S. healthcare system, you know that logic is not necessarily a big part of how it operates, or the U.S. government as well. So,
well,
you're making some very good points. But
fun factoid: Ozempic is you can't get it in Canada; it's completely sold out. Let's get to the Baker's Dozen, number 13, and this is again something that's been occupying both you and I. Talk about this a lot, actually, in terms of we like to talk about broader economic issues and their impact on retail. I think number 13 is what would we call it? It's not exactly stealth, but it's pretty important.
Well, I mentioned this because it's not directly a retail prediction, but it's more broadly about what's going on with commercial real estate, but office space in particular. And I believe that it's hopefully, in one way of looking at it, because it's a pretty negative kind of prediction, commercial real estate becomes a slow motion crisis. If we're lucky, I hope it doesn't turn into a more significant crisis. But it seems like office occupancy is settling in most cities around the world, but at least in North America, around 50%. And this, of course, is leading to high vacancy rates. But a lot of, as we've touched on, I think in past episodes, a lot of the lease expirations haven't really been dealt with, because companies are signed into these long-term leases, and now they see, actually we don't need nearly as much space. So as those leases become due, and or as the owners of the real estate have to deal with their refinancing and things like that, this is going to put a lot of downward pressure on prices, and this is going to have a ripple effect in terms of landlords' ability to meet their debt obligations or sell their properties or whatever they were intending to do, which then also conceivably has a backlash to some of the banks or any of the people that have financed these properties. So I think that we're going to see this unfold over the next several years, and hopefully it becomes manageable. But the ripple effect in terms of what it might do to consumer spending, interest rates, this general macro climate could be relatively significant over time. So I think it's just something to watch. And like I say, I hope the impact of it is relatively gradual over an extended period of time, rather than something that becomes kind of a mini financial crisis.
And just a note for listeners, one of the ways that I keep track of this is the Castle Index. And Castle runs the swipe cards for about 2,600 buildings, 138 cities in the U.S., and they publish a weekly index. It's called the Castle Back to Work Barometer, which is, I hated the name because not like I'm not working at home, but anyway. And it publishes a weekly list, and the last time I checked it, it was 51%. It's that number you but that's where those numbers come from. Yeah. That's one of the sources. So if anyone's interested in kind of tracking this, that's a pretty good resource. All right, well, that's our 2024 prediction episode. Thanks for tuning in, and let's leave it there. Thanks for tuning in. New episodes of Season 8, presented by Celonis, will show up each and every Tuesday. And be sure to tell your friends and colleagues in the retail industry all about us.
And I'm Steve Dennis, author of the best-selling book, Remarkable Retail, and my new forthcoming book, Leaders Leap, Transforming Your Company at the Speed of Disruption, which will be published in March and is available for pre-order at booksellers everywhere. You can learn more about me, my consulting, and keynote speaking at stephenpdennis.com.
And I'm Michael LeBlanc, consumer retail growth consultant, keynote speaker, and producer and host of a series of retail trade podcasts, including this one. You can learn more about me on LinkedIn, and you can catch up with both of us next in person at Shop Talk in Las Vegas this March. Safe travels, everyone.